Well, good morning and welcome to the bank. It's certainly interesting days. With me I've got John McDermott, who's the Assistant Governor and Chief Economist. The Reserve Bank today reduced the official cash rate by 25 basis points to 1.75%. We considered the decision this morning in light of the US election results and reaffirmed that we believe it was the right decision. Significant surplus capacity exists across the global economy despite improved economic indicators in some countries. Global inflation remains weak even though commodity prices have come off their lows. Political uncertainty remains heightened and market volatility is elevated. The exchange rate remains higher than is sustainable for balanced economic growth. Together with low inflation, it continues to generate negative inflation in the tradable sector. A decline in the exchange rate is needed. Domestic growth is being supported by strong population growth, construction activity, tourism, and accommodative monetary policy. Recent dairy auctions have been positive, but uncertainty remains around future outcomes. House price inflation remains excessive and is posing concerns for financial stability. Although house price inflation has moderated in Auckland, it is uncertain whether this will be sustained. Headline inflation continues to be held below the target range by ongoing negative tradables inflation. Annual inflation is expected to be within the target range from the December quarter, reflecting the policy stimulus to date, the strength of the domestic economy, and reduced drag from tradables inflation. Monetary policy will continue to be accommodative. Our current projections and assumptions indicate that policy settings, including today's easing, will see growth strong enough to have inflation settle near the middle of the target range. Numerous uncertainties remain, particularly in respect of the international outlook, and policy may need to adjust accordingly. So thanks very much. Happy to answer questions.
Governor, could you just run us through what you meant when you said you reaffirmed today's decision in light of the US election result? What were your thoughts about it, and could it have changed the outlook for you in any way?
Well, we got together and considered, did we want to amend the statement in any way? Did we want to rethink our decision? And we came to the conclusion that we didn't need to do either. We've cut because we've signalled the cut. We've been very clear in our communications about that a cut we felt would be needed to get the growth that we need to deliver the positive output gap to deliver inflation to the middle of the target range, particularly given that we've had negative tradables inflation for 5 years, and it's a big drag on the institution, its ability to get inflation back to the middle of the band. We also felt that if we cut, that we would reduce the risk of short-term inflation expectations falling, and that if we didn't cut, then we ran the risk of seeing the exchange rate appreciate. So, we went through that reasoning and said, has anything we've seen overnight caused us to change our assessment of that? And we concluded no.
You speak about international uncertainty. You refer to international uncertainty. Is that a reference to a Trump presidency?
Well, it's one of the risks. I mean, there's uncertainty about a lot of things. There's uncertainty about Brexit and Article 50. Theresa May has indicated that the UK will trigger Article 50 by March. There's a lot of issues around what that process might look like and what the negotiating stance would be. There's quite a lot of uncertainties around China. We've just seen the recent plenum where you saw the centralisation of the power of the president. There's lots of issues around debt accumulation in China, particularly corporate debt. And we've seen a result overnight that has clearly surprised the markets.
What do you think would dominate the Fed's thinking, the recessionary effects of Trump's trade policy or the fiscal irresponsibility of his tax policy?
Well, I couldn't comment on either of those things, but I could perhaps say how I think the Fed might think. I mean, prior to the election, the markets were building in something like about an 82 or so % probability that the Fed would raise rates in December. And then during the night, that probability fell to about 50%, and it's back up about around 80% probability at this point. You know, the Fed have terrific expertise on the FOMC. They will look at the data, they'll reflect carefully about what that data is showing. The underlying economy is probably growing at around 2%. They're very close to full employment. They'll look at certain indicators like non-farm payrolls. They'll go about their business as one might expect that they would. What you did see overnight was some interesting moves in long-term interest rates in the States. Initially, you saw the 10-year bond rate come off about 13 basis points. Now, given that if you're an investor, you're dealing with long-duration securities, that's a pretty significant adjustment. And as it became clearer that a Trump presidency was likely to be the outcome, you saw the market focus very much on what some of the messages had been coming out in the campaign, and particularly on the possibility of significant cuts in corporate taxation. I think he's talked about a 15% corporate tax rate. You've seen a lot of references to a very large infrastructure program. So the market started concentrating on the fiscal risks, and particularly given that the GOP, or the Republicans, would have both the House and the Senate, and therefore his ability to put together fiscal measures quite quickly, if he so chose, is certainly enhanced. So you saw the 10-year bond rate move from minus 13 basis points up about another 33 basis points. So it's actually about 20 basis points higher than what it was the day before the election, and that's a very large movement.
Governor, do you expect today's cut to be reflected at all in term deposit and mortgage rates? Because some of the banks have suggested that even if rates were cut today, that it may not be reflected.
Well, that's very much up to the banks. If you look at the banks' funding situation at present, you know, they've got lending growth rates exceeding their deposit growth. And so they're having to move to offshore wholesale markets to get some of their funding, and that's more expensive funding for them. So you're starting to see some upward pressure on deposit rates, and you're also starting to see some increase in mortgage rates. So it's possible that we may not see a lot of adjustment in terms of lending rates. Possibly there may be some on floating rates. They may adjust a bit. But in essence, you know, this move has really been built into the rate structure. I mean, we've signalled that there's a high probability that we would be cutting rates. And if you look, say, for example, at one-year fixed rates since late 2014, they're down about 170 basis points. If you look at two-year fixed rates, they're down about 200 basis points. So in many respects, this is really a validation of what the market has been expecting.
One of the points you make further down in the back end here is the feedback you're getting from businesses. Quite a bit of investment going on, quite a bit of optimism there, and some long-term stuff. I've got two questions related to that. One is, have you had any indication formally, well, probably not informally, but certainly informally, that some of the uncertainty we've seen overnight might cause that to be on hold, because there has been some quite strong investment intentions coming through? We'll start with that one. I've got a follow-up to that too.
Yeah. Did you want to cover that, John?
Clearly, it's too early to have had any decent communication with a range of businesses in New Zealand. We will be talking to them over a period of time.
And one thing you've seen in this recovery globally has been that business investment has been relatively weak compared to previous cycles. You've certainly seen that in the US, you've seen it in the UK. And a lot of the investment that we're seeing has been in the construction sector. So to the extent that we could see business investment pick up, if that's the case, then that would certainly be welcomed.
And one of the other points you make here is that construction firms in particular looking at more strategic options around their costs, and I wondered what that actually meant.
Well, I think we went out and talked to a number of firms around the country. I think there was more than 20 or thereabouts of construction firms to see what sort of cost pressures they were under, to see what was happening with their investment intentions. What we did find is that construction cost inflation in Auckland was running at around 8%. That there was some redirection of business away from Christchurch into the Auckland market. But some of the firms were really quite concerned about scaling up their activity. They've seen stop-start cycles before. They've been reluctant to invest previously in terms of not seeing the land available for them to commit to large-scale developments. So that was very much on their minds. Did you want to add anything, John?
Okay. Governor, do you think that this is as low as interest rates go from a consumer and business point of view in New Zealand?
Well, we built in, if you look at our interest rate projections, we built in, I think they fall to about 170 and stay there in terms of the OCR. So in essence, if one wanted to be completely analytical about it, one might say there's a 20% probability of a further cut. But really what we're saying is that, look, there are a number of uncertainties in the global economy in particular, and we'll look closely at the data. At this stage, we think that we won't need another cut, but if circumstances justified it, then we would look very closely at the data and make a decision accordingly.
Governor, just looking at the line of risks that you've got cited there as under the alternative scenarios at the back, currency and funding costs seem to be sort of quite high up there, particularly with long-term interest rates going up in terms of funding costs. What are the ones that are weighing most heavily on your mind?
Well, I think there's several, and a lot of them are around the global economy. You've still got large output gaps in Europe that if you look at IMF or OECD analysis, the analysis suggests that it could take another couple of years before those output gaps are removed. So there's significant surplus capacity there. I think there's risks around China. China's growth outlook has possibly improved a bit in the short term as a result of their fiscal and monetary stimulus. But they have built up enormous levels of corporate debt in the last 7 years. So there's risks, I think, around China. I think there's risks around how much more monetary policy can do in this environment. You've seen a number of central bankers basically say governments need to do more in respect to fiscal policy and structural adjustment reform. So there's some question marks around that. There's a number of political issues in Europe as well. We've just seen an election result that has surprised the markets and surprised the pollsters. So I would say most of the risks are on the external side, but let me see what John... Do you want to add anything, John?
Yeah, I think we put in all the risks that we've been considering over the last 12 months to remind everybody there's a lot to consider and factor in. I think thematically we've said, look, there's a lot of international risks. Those are the ones you probably can see. The second theme is we actually don't know how the New Zealand public and the New Zealand businesses will react to any emergence of those risks. So there's 2 degrees of uncertainty. And then you also have to keep in mind there's various idiosyncratic things that can happen to the New Zealand economy, like the weather. So we'll just keep an eye out on all 3 types of risk.
Just to follow up, I think, on what Bernard's question was, in terms of the bottoming out of interest rates, do you think it's the bottom for consumers and businesses, irrespective of what the Reserve Bank does? And you note that BNZ has already come out and said that it's not going to be passing on any of the cut. And a second question, what are the odds, do you think, of getting debt-to-income ratios added to your toolbox, given that the Finance Minister appears reluctant?
Well, maybe John can take the first one and I'll handle the second, although I'm happy to talk about both of them. Where we are with DTIs, we've requested approval from the Minister that these be included as an instrument under the Memorandum of Understanding around macro-prudential policy. We've had a couple of discussions with the Minister. He's asked a number of questions, asked questions such as how would these complement loan-to-value ratios? What's the nature of the policy problem that we're trying to address? Are there any unintended consequences from DTIs, for example? Are there issues around measurement of debt and measurement of income? Who would be affected by DTIs? So we've had a couple of discussions along these lines, and we've got a meeting coming up, I think in a couple of weeks or so, maybe a little longer, with the Minister in that respect. We should make it clear that at this point it's not our intention, if we had them as an instrument in the MOU, it's not our intention to apply them in this situation. We're seeing the housing market come off to some degree in terms of house price inflation. There's a number of reasons for that. It might be linked to the LVRs themselves. Could also be linked to the fact that bank credit criteria has tightened up. You're seeing banks reluctant to lend. In fact, I believe they've stopped their lending to buyers who rely on overseas income to support the loan. You're seeing them tighten up against developers, particularly some apartment developers. And you're seeing their funding costs increase. As I say, mainly because lending growth is exceeding deposit growth and they're having to look for wholesale offshore markets to finance. So if you put all those reasons together, then, you know, you're starting to see house price inflation slow. We don't know whether that's going to continue. We're looking at that very closely. We'll watch the data, as one would expect, and keep an open mind on it. But that's where we are with DTIs at this stage, and that's how we're seeing the housing market at this point. Did you want to cover the first question?
Yeah,
John?
so the first question was related to interest rates. I think the important thing here is the plan is to keep interest rates low for a very long period of time. And by doing so, of course, that creates some positive probability that something could happen to change the outlook, and they could even go lower. So I would never say never. We just have to keep our mind on how things unfold, and we'd act accordingly.
Just a couple of follow-up questions. Would you agree that, given how long you've been talking to the Finance Minister about this issue, that these seem like pretty fundamental questions that perhaps might have come up in the first meeting some months ago, and that demonstrates a resistance? And secondly, I'm not asking about what the Reserve Bank might do. I'm asking if you think it's the bottom of consumer interest rates or not.
Well, our interest rates, look, at the moment, the plans is to keep interest rates low, right? And then I think related to the question you're asking, what's the nature of the pass-through, perhaps? But I think you need to understand that what the plan looks like to ensure that we generate the growth necessary to generate the inflation that we need to meet the obligations in the Policy Targets Agreement. It is one which is, a sort of steady interest rate profile. But any shift in the outlook, be it from how New Zealanders react to global developments or global developments themselves, could well change the interest rate structure. So there is a possibility, even if it's not, that high, that interest rates could actually be even lower than they are today. I wouldn't rule it out at this point. Not we think it's the main case.
On the other question, I can't speak for the Finance Minister. You'd have to ask him that himself. But we've had a couple of conversations over the last 6 weeks, and they've been very good discussions. He's been keenly interested in, addressing a number of the points that we've raised. But for further comment, you'd have to go to the Minister.
Governor, do you think that there is room to use the LVR tool again, or is it, have you done as much as you possibly can with that, and that the next option, therefore, if there is a recovery or a new resurgence in the market, is to go down the DTI route?
Well, both tools can be very helpful in terms of reducing risk to the banking sector. I mean, in essence, if you look at DTIs, they reduce the risk. They reduce the risk of forced sales, in essence, because the borrower has greater capacity to service the debt. So there's a reduced risk of getting into distress and forced sales. The LVRs are helpful in that they reduce the risk to the bank if there are forced sales, and that's because the borrower has greater equity in the transaction, so they can complement each other very well. One of the issues that comes up with LVRs is we look very carefully at the default risk. We look closely at Irish data and some other data, and we felt comfortable moving where we did with the investor LVRs because of the greater risk of default. And we felt that at 40%, we at this stage feel that we've pretty well got it right in terms of that default risk. So that's something that we would need to consider to the extent that if at any point we did have to raise LVRs, and I say if, one would have to think how does that match with the integrity of the underlying default data that you have. Did you want to add anything, Bernard, or Grant? No. Okay.
Governor, you again complained about the strength of the Kiwi dollar, which continues to be fairly attractive in what's an interesting sort of state of the financial markets, a lot of volatility there. Are the conditions ripe for an intervention? Is that something that you're considering?
That's something we'd always have an open mind on. We look at the case for intervening at the time that we take our decisions around an OCR. We've got a system of 4 traffic lights, and we look to see whether the conditions are met at any point. So we have an open mind about intervention. Did you want to add anything, Joe?
What are those traffic lights saying to you at the moment? Are they all green?
Rather not cover that at this stage.
Governor Janet Yellen talked about potentially the need for her or the US economy to run a high-pressure economy to generate some heat so that there's some real exit velocity and getting inflation up well into or past its target band. What's your view on whether that's a good idea and whether New Zealand should look at perhaps running the economy a bit hotter than otherwise would be the case to try and get inflation, well past that, 2% midpoint?
Well, if you look at the US economy, I think growth in the first half averaged around just over 1%, around 1.1 or so. But the Fed were confident that the underlying economy was growing at around 2%, and that was because of the destocking that was taking place. So you've seen I think the last quarter was just under 3% or thereabouts, and some of that was an inventory build-up, a planned inventory build-up. So if you ask the Fed how fast is the economy growing, they'd say it's around 2%. They'd say they're very close to full employment. And that's why the market at this point has an 80% expectation that the Fed will raise rates in December, and that's the judgment that they will need to make. In terms of ourselves, the economy's probably growing at around 3.5% to 4%. Non-tradables inflations, if you take out the ACC levies, the underlying non-tradables inflation is running at around 2.7% at this point. So the economy is doing well, and you certainly wouldn't want to create excessive volatility in respect of interest rates and output in the exchange rate by surprising the market with interest rate adjustments. But let me see if John wants to add.
Yeah, maybe I can emphasise the plan that you mentioned does sound like the plan that's being implemented in New Zealand. We are generating an economy that's growing faster than potential growth. It is absorbing resources, and that will lead ultimately to non-tradable inflation moving upwards, and we're seeing signs of that. And then in the next 18 months or so, we'll be back towards the midpoint of the target band. That's how you implement monetary policy. Sounds like a good plan to me.
Just one final one from me on inflation forecasting. Over the last couple of years, lots of people have underestimated the deflationary pressures. Could you explain how the bank has shifted its thinking or its modelling to adjust for those surprises, whether they're structural or whether your modelling is about right?
Yeah, okay. So there's an interesting speech on our website that you might want to look at because all the details are outlined in that. But just very quickly, a quick summary is we've probably got, by and large, the demand side of the economy right. It's relatively easier to forecast. What we've learned is there's been more supply in this economy. We've grown this economy faster without generating the inflation. And some of that has come from an increased population. Some of it has come from the mix of the population. So the net migration story has been a different age cohort, and that's having a different impact on demand and supply in this economy. And then the other thing that we've learned is that there's been a bigger global deflationary impulse than I think anybody has anticipated, and it's seen the tradables part of inflation run negative for an extended period of time, something like 5 years, which we'd never seen before. So those are the key messages from that speech.
And given that seems to be continuing going, does that mean your assumptions about the neutral cash rate is shifting down further?
So the neutral cash rate has been gradually moving down over a period of time, and that's probably reflecting the savings investment imbalances we've seen globally. So there's been less investment than might have been anticipated, and there's certainly been an increase in savings profile, maybe from some emerging market economies. And that shift globally has changed the demand for loanable funds in capital markets, and that's moved everybody's neutral interest rate down around the world.
Where are we at the moment?
We're sort of gravitating down. We're around about the 4% mark.
Governor, you've said in the past that fiscal policy could help you in getting some inflation back into the economy. Is there anything in terms of what the government's doing at the moment that do you think that some of the policies that they're running are helping you at the moment, or are there other things that you would be welcome with open arms sort of thing?
Well, you've got the economy, as John says, you've got the economy growing at a rate that's generating a positive output gap. So the economy is growing probably at around 3.5%, maybe a little bit faster, 3.5%. We think potential output growth is probably around 2.9%. So, as I say, you're creating a positive output gap. So you'd say to yourself, do you need fiscal stimulus at this point? And the answer is probably not, no, you don't. There will always be decisions that governments need to make about priorities and where they put their spending, the split between current consumption and investment, say infrastructure investment. If I look at the housing market, there are issues around increasing housing supply up in Auckland, and to the extent that there are regulatory issues or there are land availability issues or infrastructure constraints and bottlenecks, and if that's something that could be handled through expenditure reallocation or engagement with the councils and to get improved outcomes, then that's all to the good. But I don't see any need at this stage, given where the economy is, for further fiscal stimulus. Thanks very much indeed.